Hedgeable. The webinar today is Redefining Alternatives. This is really a hot topic these days where people are looking at allocating capital to alternative managers versus non-alternative managers, and how does that fit into the overall asset allocation bucket. So in this presentation today, we're going to look at a few things. Number one, the traditional view of alternatives. So what are the benefits of them? How do they come about? Who are some of the big hedge fund managers, which is typically what you think of as an alternative investment. And then number two, what are the new trends in portfolio management? So that's really the rise of ETF strategies. And number three, what we mean by redefining alternatives. And you'll hear that very frequently throughout this presentation. So we have a nice little chart that we made here called Redefining Alternatives. This is a pretty simple concept. So if you look on the left side, the traditional portfolios, what most advisors would use is 60-40 or 80-20 portfolio. The one to the right of that is really what's come about in the last 10 or 20 years is the alternative portfolio. So it's the same portfolio that's 60-40, but you're carving out a percentage of that for an alternative bucket. The third thing is what we like to say is redefining alternatives. So why, instead of having that 60-40 portfolio or that 80-20 portfolio that has that 15 or 20% carved out for alternative strategies, why not manage that entire portfolio itself like an alternative investment? So in a more alternative way. And we'll go through that in much more detail over the next few minutes. That's really what we mean by redefining alternatives. So the first thing we're going to look at is what are the traditional benefits of alternative investments. So there's really three things that most people would consider benefits. Number one is alpha generation. Number two, hedging. And number three, the smoothing of returns. So if we look at the alpha generation portion, this is a chart that BlackRock made up, and it's very simple conceptually. What they said was, let's take a few portfolios that have equities and fixed income, and let's add in alternative asset classes. And by doing that, let's take a look at what changes in terms of the risk and return profile of the portfolio. And that's really what you see here on this chart, that along the scale, as you add more equities or take away equities, it doesn't matter. Adding the alternatives increases the performance and decreases the risk. Essentially, this just means that there's a higher Sharpe ratio for the portfolio. And number two, a lot of people will invest in alternatives for the hedging ability. So really what they're looking at there is correlations. So what we have here is a chart that shows historical correlations. This is when the heyday of the hedge fund industry. And you can see the correlations were very low. But when you looked at what happened in 2008, the correlations all became very high, and that's one of the things that people started to look at was that historically correlations are low. In crisis periods they become high. So maybe just allocating to alternatives isn't enough. The third thing is really the smoothing of returns. So here's a chart that Bridgewater provides to their clients. And what this shows rather simply as well is, if you manage something in a more alternative fashion, how can you smooth the returns? And so what we mean by smoothing of returns is having much lower jumps in the daily volatility of the returns or the monthly volatility. So you see that with this blue line. What they were able to do by holding a lot of non-correlated assets is produce a very smooth long-term growth without the volatility or the drawdowns. And you can see that here. It's the same return, but with a much lower volatility, a much higher Sharpe ratio. So this is traditionally what people would look for in alternative kind of investments. So we take a step back and we go, and now let's look at who are some of the big players in the alternative space and how do they use these concepts. And so we're going to look at three guys. These are the large, very well-known global macro players, because you'll see in a few minutes how we're able to transition what a global macro kind of manager, how they manage their portfolio. And we can transition that to how we can manage a portfolio without all the instruments that they have at their disposal. So number one is Ray Dalio. So we're going to look at some of the things that Ray Dalio allocates to. And number one is the Pure Alpha fund that they do. So in Pure Alpha, the goal of the fund is very simple. It's to create incremental alpha. So you have a beta portfolio, and then you overlay that on top of some alpha generators that are not correlated to that beta. You'll see that here on this chart to the right. They also do something called all-weather, which a lot of people these days call risk parity. Risk parity, which you'll see on the left side, is very simple. What they say is we know what asset classes are going to go up and going to go down during a rising and falling growth and inflation environment. So if we know how those things interact with each other, we should be able to make a portfolio and then take risk on, take risk off, that shows those attributes and has a low correlation and a high alpha. So you can see that in these two charts here. The second person a lot of people think about in terms of an alternative manager would be George Soros. George is very famous for playing the currency markets, interest rate markets, etc. So the third person we're going to look at is John Paulson. John was known as playing more of the credit markets, and all this is going to tie together in a few minutes. When we walk through how we can transition, how a global macro manager looks at a portfolio to how we might or another ETF-based manager might. So John Paulson, he plays the credit markets. So he's looking at arbitrage and merger arbitrage and distressed credit. Things that most people would say are, this is way too complex and too complicated. There's no way that we could do this in our portfolio. And by doing this, in 2006, he was able to say that, hey, subprime mortgages are overvalued. I'm going to start shorting these securities, and because of that, he had a huge return. So really, what we're going to try to transition that to is, okay, we know that these guys are very successful. They make a lot of money with these strategies. Most of these strategies aren't going to be accessible to most of us and most of our clients, and they're going to have high fees. So let's try to build a portfolio that looks very alternative in nature. It might do some of these things, but on a much higher and simpler level. So that's what this chart shows here. It's what we say is what alternatives should look like. And what this represents is the Bridgewater Pure Alpha strategy, one of the most successful alternative strategies in the world versus the S&P. So you can see this is very alternative in that there's going to be a low correlation to the market. There's low drawdowns, there's much lower amounts of volatility, and much longer-term straight-line growth. And then the second chart is what alternatives shouldn't look like. So if we're going to try to transition and pull some of these rules that some of these very famous, wealthy hedge fund guys are doing and transition that to our portfolio, we're going to try to look to see, well, what are people doing wrong in this space? And here's an example of that. This is just a random example. We're not picking on JP Morgan here, but this is one of their market-neutral mutual funds. You can see how this is just totally opposite of what a alternative kind of allocation should look like. It doesn't capture any of the upside of the S&P. It's pretty much flat the last few years. So with an alternative strategy, you really want to try to capture upside and reduce downside. And we're going to talk about that from the second part of this presentation, how we do that. So this chart here shows the correlations in 2008 and 2009. So as we look forward and we go on to the next part of this presentation, how do we prevent that from happening? How do we prevent, number one, how do we build a portfolio that captures some of this upside, decreases downside? But number two, how do we build a portfolio that doesn't have that high correlation during financial crisis periods? And that's really what we're going to talk about now, is the rise of ETF-managed portfolios, ETF strategies, and how we're, in a more simple fashion, able to try to alleviate some of these problems that you might see in alternative investments. So right here's a picture. This is the Bridgewater Pure Alpha strategy from 2007 to 2011. So it's a full market cycle. And this is the drawdowns of that strategy. And you can just see that when it's overlaid versus the S&P 500, how much more risk management they're doing in that strategy than if you were just to allocate to a S&P 500 index fund. So the question we always pose is, why can't we or someone else do the same thing? And the answer is, you can. Everybody can do this, and you don't need to use leverage. You don't need to use shorting or derivatives. So this is really what we're talking about in terms of redefining alternatives. We don't need to allocate to these managers to try to achieve the same thing, not just in a 15% sleeve of the portfolio. We could do this in the 100% sleeve of the portfolio, in the entire portfolio. So this chart here shows that. This is a diagram of our returns in our U.S. equity strategy, which uses our dynamic advisor technology, and also another similar firm called F Squared, one of their strategies. And that's overlaid on top of the S&P 500. So you can just see the difference in risk management. And this is only what we're doing here is selling out of ETFs, going to cash or fixed income during crisis periods. So we don't need to use derivatives. We don't need to use leverage. We don't need to use shorting. And we also don't need to allocate to these hedge fund managers and pay them high fees. We can hold a few ETFs which mimic the market. And by doing that, we're able to play like a global macro manager, but without any of the risks that come with being a global macro manager. So how do we do that? How do we achieve this risk on, risk off kind of thing that Bridgewater might be able to do well, or Suros might be able to do well, if we're not using futures or options or anything like that? How do we build a portfolio with low betas and correlations and volatility? And you can see that here. This is a chart that Bridgewater produces. We know during certain periods how securities interact with each other. So whether it's a rising rate environment or a falling GDP environment, we know historically how these securities interplay with each other. And because of that, we're able to, with ETFs, move quickly in and out of markets when there's certain indicators that happen in terms of volatility and drawdown and just overall risk in these individual markets that we're invested in. And this is exemplified here. During different periods, stocks or bonds are going to do either poorly or they're going to do well. So by moving out of parts of the market that are doing poorly and into parts of the market that are going to do well in different environments, we're able to capture that upside and really eliminate most of the downside. So this is conceptually the same thing that a global macro manager might do, but we're not holding thousands of securities. Like I said, we're not holding all these complicated instruments. How we do it and how similar managers might do it is instead of overlaying with all these complicated inflation-linked bonds and credits and futures and commodities, we just look at markets at a very macro high level. So buy SPY, which would be the S&P 500, or buy AGG, and then sell SPY or sell AGG, which is the aggregate bond index, and go to cash. So really all we're doing is we're moving in and out of markets quickly as fundamentals and technicals indicate in the markets. And if you go into any research session or trading floor of a big macro shop, this is essentially what they're doing. But they're doing it on a much more nitty-gritty level with many more securities. And you can see by doing this and not being invested in markets when they're the most volatile, how that impacts the risk-return attributes of the portfolio. So this is an example of one of our strategies. You can see the beta to the S&P 500, and this is a portfolio that, if you didn't do any trading, would have an almost 1 beta. So it's a heavily U.S. equity biased strategy. And you can see by moving into cash when the market's most volatile, how you're able to reduce beta, how you're able to reduce correlation, how you're able to reduce R squared. By doing stuff like this is how you're able to produce those long-term, very smooth returns that we saw in the Bridgewater chart. So the last part of what we're going to look at is, redefining alternatives. What does that mean? And for us, it's really about, number one, risk management. So everything that we offer is actively risk managed. And when I say it's actively risk managed, we don't use, options or anything complex or that adds a lot of cost into the portfolio. We're doing this dynamic taxable asset allocation that I talked about a few minutes ago. We're moving out of markets when they're most volatile and only are invested in them when there's low volatility and high chances to create alpha. And you can see that here in the drawdowns of one of our strategies versus S&P 500. Number two would be simplicity. We've always believed, and there's been a lot of studies and books written about this, that by holding a lot of securities, doing a lot of trading, you actually decrease returns in the long run. So everything we do is very simple. We usually hold 5 to 7 securities in portfolios. These are very large securities. We typically don't hold anything that has low amounts of liquidity and volume, etc. So it's very easy for us to market this, and for end clients, we're working through an advisor to show them that we're holding huge securities, they're very stable, and they're able to track large markets. So we're able to very closely on the upside track, and then the downside able to reduce those large drawdowns. The third thing is we provide a lot of technology, and we built a lot of technology. So we have over 100 technology systems we developed. It's really the same thing if you went to any global macro shop. They have a lot of technology on the back end that's able for them to do more research, do more analysis, do trading more efficiently. We have an online platform that we provide to all of our clients as well. So everybody that we manage money for, we provide a full, transparent, 100% live, 24/7 platform that anybody can log into, and you can see exactly what you hold, what the news and commentary is on the securities, performance, risk, bar analysis, drawdowns, custom benchmarking, you name it. And these are things we don't charge for. And this is really where the market's moving. More transparent, lower cost. If you look at a typical hedge fund, even if you're allocating only 15 to 20% of sleeve to that particular manager, you're still paying them a significant amount of fees, and it increases the overall fee that the client pays. What we contend, and really where the market's moving as well, is going more towards a wrap, very low overall fee for the whole portfolio. There's no need to do alternative programs and buckets. Just the whole portfolio is managed in this fashion, and there's a low cost applied to it. And really the next thing I want to talk about is this investment philosophy that we have and others have, how that relates to this whole notion of redefining alternatives. So most alternative managers, the good ones that have been very successful, would say their number one thing that they're concerned about is protecting clients on the downside. That's where the term hedge fund comes from. It's the hedge of portfolio. It's not speculation. So we've always thought that to be very important, that those are the good ones that get paid the most money. They're looking for low correlations and low drawdowns. But on the flip side, they're marketing to clients that they can capture upside. So really, we're trying to do the same thing: is minimize drawdowns, capture upside, and then by doing that, you're going to have very good long-term growth that's very stable. And that brings us full circle back to this concept. So really, what we spoke about on this webinar was, let's look at the traditional 60-40 portfolio. How that came about over the last 50 years. It's very successful when markets go up, but since 1990, it's been the standard practice to add out some kind of alternative asset classes into this portfolio. So that right now is usually 10 to 20%. And really going forward, as we look into 2015 and beyond, we believe that the trends are showing that most portfolios won't have these buckets. They'll be managed the same way that they have been for the last 50 years, but with new security types, faster trading, more transparency, more technology, and just more access to these kind of strategies that the big boys use really the trend is going to be to manage the same portfolio but in a more alternative way. And that's really what we mean by redefining alternatives, and really what we want people to get out of this webinar. So I'm going to open it up to questions now. If anybody has questions, I'll let everybody ask questions for the next 5 minutes or so. My contact information's up here. We have a webinar scheduled about once a month. The next one is a save the date for September 25th that we'll be sending out. So just let me unmute everybody here, and we'll open it up for questions.
Hi, thanks for your comments. Find it insightful. You mentioned, utilizing a tactical model. Can you just explain how tactical you are?
Sure. So we look at markets and securities and portfolios on a daily basis. So we're able to move. I know a lot of managers might look at things on a weekly or monthly basis. We look at everything on a daily basis. So let's say we're in an all-asset kind of portfolio, so we can invest in any asset class. If we see a shift away from U.S. equities to emerging markets, for instance, we're able to that day do that trade. So we're very flexible. We don't do a lot of trading. We try to keep trading to a minimum. But when we see these opportunities in the market or risk in the market, we're extremely tactical and we won't wait. So it's a good thing about using ETFs. And like I said, it's really part of this whole technology revolution where we could do this instantaneously for clients across millions of accounts in the click of one button. Okay, if there's nothing else, we will have this webinar up online within the next 48 hours or so. We'll also send out a link to everybody who's on, and if you have any colleagues that weren't able to attend, we'll send that to them as well. My contact information is here. Sales@Hedgeable is our sales address. You could also email me directly, mike@hedgeable.com, or you could talk to Hunter Ward, who's the head of our distribution, who some of you might have been in contact in the past. But hopefully everybody found this insightful, and I hope you enjoy the rest of your afternoon.